So over the past 20 years, we have seen two different, but both equally really successful models in driving growth at scale. The first one was technology investments. Right? Technology investments funded by the venture capital ecosystem and then later by growth equity funds has really driven a lot of the scale in that business, and all scale driven by private demand. And on the other hand, you have seen a remarkable scale-up of renewable energy, specifically solar PV and wind, as Jan explained this morning, beating expectations by 125x from where they were 20 years ago. And a lot of that was driven by government incentives and by project finance. And what we're trying to do here with carbon removals is almost something in the middle. There's a lot of tech aspect in here, there's a lot of innovation still in here, there's a lot of excitement on the customer and consumer side, there's tremendous potential for growth, but these are also real assets. There's real steel and real concrete that needs to be built. So what we're looking for is almost sort of a new kind of asset class, and we're going to need to achieve similar scale-ups as we've seen in technology and renewable energy if we want to solve this problem. So I have here with me on the panel representatives of a couple of these dimensions, so I'd like to welcome them. We have with us Riddhima Yadav, who is part of the renewable and transition team at Brookfield, so doing a lot of strategic initiatives for decarbonization. Brookfield is one of the world's largest investor in renewable energy and a lot of other transition projects, including the two global transition funds at $15 and $17 billion each. We have also with us Zachary Webb, who's head of Catalyst investments for EMEA. Catalyst is an evergreen growth equity fund, part of M&G Investments, a large asset manager based out of the UK, and a current investor in Climeworks. And we have Kofler, who is managing director at JP Morgan and an investment banker in the energy, power, and renewable sector, and sees sort of the broad spectrum of the entire market. Welcome. So, as my opening question, you all have looked at the market of carbon removal and direct air capture. Where do you see the potential, but also the challenges of these markets from an investor point of view? Maybe we'll start on my opposite side with Hannes.
I think being here today and seeing Climeworks and seeing the tremendous progress that Climeworks has been making on, particularly on the technology side, but also putting the technology out there in the field and ultimately proving to the world that carbon removal from a direct air capture perspective is a real alternative, I think is extremely encouraging. I think this encourages us at JP Morgan. I think we look at, obviously, Climeworks as being one of our customer on the CDR side. I also obviously look at this from an advisory perspective to the carbon removal sector, but medium and long-term JP Morgan will also look at this from a financing perspective. So I think the technology side and ultimately the policy side are two things that make us very positive about the ramp up that this industry has ahead, and ultimately the ability to scale it on a long and durable basis, and importantly for a bank on an auditable basis as well.
Zach, how do you see this from a growth investor perspective?
Yeah, it's challenging, but potentially incredibly rewarding. And first of all, thanks for staying for the graveyard shift when you see it's the finance panel. It's amazing to see the room is still full. You know, in one sense, you know, when we first invested in this in early 2022, it was about a month before the IPCC came out and actually even recognized DAC as being, you know, something that was part of it. We were having conversations about moral hazard up until that point. So, you know, it's amazing to see how far that we've come since then and what that has unlocked at a sort of a government and a societal level, and we're only at the start of the education piece around that. And then what comes with education is value and how we think about value. And today, this is not the most valuable thing in the world, but in time, this could become the most valuable service in the world. So the way we thought about it was it's sort of critical that we do it. We also thought about it as this is a push on humanity's ability to meet the climate goals. which we're missing. And then, the challenges of it is the payback is so long. There's only so many investors, and we've had this chat many times, that actually can take a long enough view. And there's only so many investors out there that can think about growth in heavy capex. When you think that the venture world came from, software technology, but they have got the timescales, but they don't do capex. It's not, it's a new thing for them. And then the infrastructure investors, they come from a contracted offtake world, which I'm sure we'll come back to talk to. And then the private equity guys want to be out in 3 to 5 years, and they also want to have profitability already. So then you need as you spoke to, a new type of investor, a new type of asset class. And there's only so many of those that are out there.
So Riddhima, since Zach mentioned infrastructure investors, so Zach, I heard potentially the most valuable thing in the world. We'll take that with us. But it's going to take a while. So how do you see that, Riddhima?
I'll say 2 truths and then the ambition, right? The ambition being that, or actually let me start with the 2 truths. The first being Brookfield really operates on scale. If there's one thing that really defines the renewable platform, our business on transition, et cetera, it's scale. Second truth, carbon dioxide removals are an important component of the net zero toolkit, and it's needed. Like there is no disagreement on that. When you match those two, the ambition is how can we get to a point in time in the future fast enough to marry those two? And I think that's what we're trying to figure out right now. There's absolutely a lot going on in the ecosystem. And when I say ecosystem, I mean the broad swath of corporates and suppliers, actually the project developers themselves, the technology, the R&D, the scientists, an incredible amount of human capital, not just social and real capital going into the space. And so we are exploring and sort of really closely tracking the space to see where it goes, because there is an opportunity ultimately to get to that kind of scale should some things come together in a way that will actually unlock the kind of capital that we have.
Right. So you mentioned some things need to come together. You obviously were, as a firm, as Brookfield, a big part of that rapid deployment of renewable energy that we've seen over the last 20 years. So what are some lessons that you think carbon removal companies and direct air capture companies can learn from that rapid deployment? Yeah,
that's a great question. I think the sort of, I'd say, scale up of renewable energy has a lot of lessons to offer. 3 I'll highlight for this audience. One is, I think there's very sort of clear, in the early days, sort of a lot of clear and large policy incentives offered upfront to help bring down some of the costs on behalf of governments. And that sort of was really taken up by a few front-footed governments with sort of very tangible benefits that gave the clarity and the signal to a lot of the developers to take on that risk upfront. The second is around corporate demand, but also in a way that you match the market demand by building capacity at the same time. Because mismatching that can be an interesting dynamic. So a lesson is you build market demand, but you also build capacity in parallel. And you do that by really stimulating the corporate demand. At this point in time, fast forward since solar first really started peaking around the early 2000s, as you and I were talking about, we're seeing an insatiable demand from corporates for clean energy. The hope is, and my dream is, that at some point we'll see the same for carbon dioxide removals. And I think that's something that can really put this entire space on a rocket ship. The third, I'd say, is just a very brutal approach towards bringing down the cost curves. And by that, I mean a lot of collaboration between the network effects of shared learnings between different players. And obviously, everyone has to preserve their secret sauce, but there is something to be said about collaboration and shared learnings to overall systemically bring down costs. And that actually has a very direct impact on CapEx. A very specific example I'll give you is in gas turbines, 15% reduction in CapEx for by doubling the production capacity, which was a direct result of the sort of impact of the technology cost curve. So you see that pretty clearly coming up in terms of the economics. And that's something that would be great to see emulated for this space to grow. So
a lot to unpack here. Government incentives, but also strong private corporate demand. And on top of that, the companies really driving down the cost on the cost curve. And you mentioned also working on network effects and collaborating more to be able to drive down the cost curve further. So maybe if we unpack that a little bit more, Hannes, you've spent quite a lot of time in this space. We personally had a lot of discussions on the market. What's your view? Where do you see the market for carbon removals now, and where is it going in the next 5 years?
Yeah, I think when we think about the market of carbon removals, I think it's important to say that I think about this as 4 steps, really. And Climeworks has taken the first 2 steps. They have developed the tech, they've put the tech out in the field at scale, they have effectively built the relationship with the customer, and now effectively we're going to step 3, which is scaling it up to a megaton. And in order to scale this up to a megaton, effectively we need help from, importantly, the customer, we need help from the value chain, and we need help from the financing market. That 3rd step will still be a painful step in terms of that customers will have to come in at prices that are probably above the levels they may want to commit at the long term. But importantly, that will ultimately, similar to what we have seen in other renewable technologies, enable to bring the costs down in the long term. And the long term for us is, one, we had the discussion earlier around the carrot and the stick. I would love to see the market develop just with the carrot in terms of the volunteer market. But with carbon, at the end of the day, for most organizations, or for almost all organizations, it is a cost. And as we think about that cost needs to be split across society. So you need a mechanism long term that ultimately allows carbon removal to almost scale like a utility type business model that we see today, i.e. the owner and operators of these plants earn a regulated return that ultimately remunerates the capital provider and essentially spreads that cost. I'm very optimistic around step 3 that we'll find enough corporates that ultimately take the offtakes for the next step, but essentially the step out, we also need governments and regulators to step up to make this a long-term sustainable business model.
Zach, do you agree with that? Have you invested in a utility ultimately?
Yeah, I mean, what I absolutely agree with is this is a cost that needs to be socialized. I think that there's we've had a dramatic change since the IRA in terms of the profile for DAC, and I think with that you're sort of getting to a point now where the average voter probably can't discern the difference of whether you should use green energy to clean a dirty industry or whether you should use it to pull carbon out of the air, right? It's too complicated. And we're not at the point yet where people understand, they'll still vote for car manufacturers. They'll still vote for steel. They won't even vote for putting a semiconductor plant in, even though that might be one of the most important things that they do for, a country, right? So it's what gets the votes. I'd love that we got to the future points where people voted for DAC plants, but I think it's a bit that it's almost like getting 30-year-olds to think about their pension, in later life, or taking out life insurance, right? People can see that long-term value of what this is, and we need to start investing in it today at huge government levels in order to get to the type of scale, that someone like even a Climeworks as a market leader needs to get to, that you can set up several plants in a year at a time, right? And so, when you think about that, then it's socialized. It has to be a socialized cost. Is it done via RAB mechanism? I don't know. But is it done via a ton of grants and subsidies or feed-in tariffs or whatever it might be? I absolutely think that's it, right? We don't pay for the price of a pint of milk. I don't know what the true cost of a pint of milk is, and the farmer gets paid a subsidy on the other side as well, right? So this is going to be one of these things that, because it is a cost base, it doesn't have a value in the same sense of like the energy that you get from renewable energy has and the exergy that's related to that. And so you will have to socialize that cost. And there's a ton of mechanisms to do it.
Yeah, yeah. So important point there on also the dichotomy between what is cost versus the value of performing this service for customers, but also ultimately for society. Maybe Riddhima, with investors, we often discuss the importance of long-term fixed take-or-pay type offtake agreements to bring down cost of capital for everyone who needs these services. What are the reasons why that's so important? And if you put yourself in the shoes of an offtaker, what case would you make for them to do fixed procurement today instead of waiting until later?
Yeah, it's a very good question. I think the way we think about this opportunity set is almost with an obsession, if you will, with offtake contracts. Yeah. And I think that is directly linked to visibility as an investor in terms of the future profile, the growth, how you should be thinking about the investment 10 years down the line. Of course, there are exogenous factors, but having that visibility and that clarity up front is an incredibly powerful investment signal. And so therefore, a crucial piece of the investment decision making. In terms of how to think about some of these contracts, a lot of people say, okay, is $100 the magic number, or what exactly is a magic number? I'd say the magic number is actually the 10 billion that is needed by 2050, because that is such a strong demand signal to everyone to say, this is the need now, let's work backwards to see what are the best economics that can get us there. And obviously, it's a journey across time. And to your second question, I'd say when you're thinking about sort of contracts, obviously the fixed nature of it is really important. There are components that could be variable, but what are they dependent on? How do you bake in other ways to sort of build the capital stack, if you will, recognizing that a corporate can provide one very crucial component of funding, but there are additional funding sources, and so what is the visibility on that as part of your overall contracted nature of the projects? And then ultimately, what is the relationship between the projects themselves and the entity as a company, and how are you sort of developing that as an infrastructure fund as well? Are you thinking about it in terms of scaling the projects? Are you thinking about it in terms of the company? And so you can think of very creative ways to approach those. Yeah.
So Hannes, you mentioned before, you're not only an advisor in the space, but JP Morgan as a firm has also committed to a long-term offtake agreement on different forms of carbon removal, including direct air capture. So what, from your point of view, was the case for that to invest in that already today?
I think for us, ultimately, it is for us jump-starting a technology that we fundamentally believe in the medium to long term. And I think, as I said at the very beginning, it is those qualities that carbon removals have in terms of obviously the sustainability, the durability, the longevity, but also the scalability that aligns very well with the principles we also have at JP Morgan. And this is why we have made that decision. And at the end of the day, for us, it's also important to show that there is obviously large-scale customer demand, because that large-scale customer demand is ultimately important to ensure the bankability of these projects. And I cannot reiterate that enough. Obviously, we talk a lot about cost out from a value chain perspective. We talk a lot about technology advancement, but being able to access the cheapest cost of capital, both across equity and debt, will be a fundamental necessity to get this ecosystem up and running. And the earlier we can start to effectively bring down the cost of capital by locking in some of the longer-term offtake, the better it will be for the industry overall.
And how do you think about scarcity? So you have a big picture of the market. Obviously, a lot of people here in the room will have made net zero commitments already and are serious about meeting those net zero commitments. Do you think the supply will even be there to meet those net zero commitments?
Look, I mean, it's a difficult debate, and I was told like 70% of the people in the audience are corporate people that probably in the sustainability area or look at their own net zero commitments, so everybody will have a different view. But I think I probably can speak for many corporates that people are looking first at their 2030 targets, and I think the gentleman from the European Commission also tried to highlight that before they think about 2050. And for us, as we look across the industry and at companies, I think a lot of companies at the moment are focused on essentially removing the low-hanging fruit, which may get them to their 2030 targets. And really, as we approach 2030, it will be really interesting for us to see how those corporates reaffirm their long-term commitment to net zero. Because it's very easy to replace or to sign up to 100% renewable electricity offtake. It's very hard to effectively remove the last 20% of your emissions.
So, do you want to jump in
here?
here?
Yeah, no, I do, because you know I have this thing you were mentioning there about value and cost, and we're talking about, there is one side of this which I 100% agree with about getting capital costs down, getting costs in general down on this. But the other side of this is value. And, you know, and it was John Pierpont Morgan who had a comment about this when the house is burning, which ultimately it's going to be. So give this 10 years, and I'm sure that people are going to think differently about value here. And that's why I'm saying it's about a socialized cost. As long as, let's just say it stayed at $700, right? As long as that $700 isn't a price signal from an efficient market that tells you that the energy efficiency is terrible, and therefore you shouldn't do it. If the energy efficiency of DAC works, then who cares about price, right? We're moving into this AI world where, you know, what are we going to attribute value to? We're going to move back down Maslow's hierarchy of needs. We used to be pegged to oil, post being pegged to gold. And sorry, I'm going to go off on one here for a sec, but, you know, the next thing is going to be about our survival.
Yep.
And this is one of the things that you can do. So whatever price you need to pay to absolutely grow this industry, you will do it. And people will pay it. And that's why I'm saying it may need to be a socialized cost. You might need to have a contract for difference. Is it going to be corporates paying out of their marketing budgets? I don't know. Will it be something greater? Will it be something where there will be stick as well as carrot, and the stick will go much broader than the likes of EU ETS? And there's also this kind of fallacy, I think, with people around, you know, that everything has to be the same as the old cost, right? So I don't know where that $100 number came from, but we don't need to get to $100 as far as I'm concerned. Somebody just made that up because that's the price of not changing your behavior. If you actually are going to change your behavior, there's a value bit, but then there's also a value attribution argument. So this shirt, as an example, probably costs, you know, I don't know whether this sounds good or bad, probably costs 100 quid, right? But it probably costs about 10 quid to make. So who else are we giving value to, right? In that kind of post-cheap manufacturing world, it's all about branding and all this kind of stuff, right? So if I could make the shirt green and recycle it green, then maybe it costs 20 quid. So all that I've done is reattribute it. I can still sell it for 100 quid, but instead of some kid getting paid to do the marketing of it, we're paying 20 quid for the right price to manufacture the thing properly. And that's the way we should think about it. And if it became £110, who cares, because that's how we're going to move our value. In the same way, we could think about value as people paying NFTs for Bored Apes or for, you know, digital currencies. I'm not saying that's necessarily a bad thing. It's just about what you choose to value. And I would choose to put, you know, energy into sucking carbon out of the air because we're going to miss every other target.
Super interesting.
So don't get too focused on costs is what I would.
So picking up,
but get your costs down.
Yeah. So picking up on the sticks and carrots, Riddhima, I know you work a lot on the intersection between industry, finance, and policy. So over the last 24 months, we've obviously seen a huge amount of recognition and public policy movement and incentives for carbon removals and DAC. Do you see them going in the right direction? What, from your point of view, would be the crucial recommendations to the policymakers, and I know there's some in the room, to get more investors into this space?
Yeah, so I think directionally it's positively trending. Now the speed is something that could be argued about, and I think no one would not agree with the fact that we can be going faster than we are, including on policy. I think the dynamics, as Zach alluded to, have changed with the IRA, and so that's a very good signal. I think the lessons to draw from that are that it really helps to have a very stable and clear, simple, stackable approach to accessing it. So not simple is the way to go when it comes to accessing some of the sort of policy, revenues and
Keep it simple.
ideas. Yes. The second thing I'll just quickly mention is there is a lot of demand waiting behind the curtains, which is voluntary driven, as Hannes said. But there's also an opportunity for governments to think about the linkages between voluntary and compliance schemes to continue to stimulate that demand in the interim. So, for example, something that Japan did was announced that the CDRs are now eligible for some of those compliance schemes, ETS. So I think that those sort of initiatives are always a helpful market signal, and we definitely need to see more of those.
Okay, thanks a lot. So we're almost out of time, but final statement. If you were in the shoes of a fast-scaling carbon removal company, and we have a couple of them in the room here, what would be the single most important recommendation to help finance it? Let's start with you, Hannes.
Focus on unit economics and try everything you can to get the costs out from your value chain.
Zach?
I would do that, and I would educate people about the value.
All right.
I said the 3 C's, so capital stack, contracts, and creativity.
All right. Thank you very much. I think that deserves an applause. Thank you very much for our great panelists. All right.